Good morning, traders. Today is Saturday, April 30th. Tomorrow's May 1st, Sunday. We're going to go over the markets. We've had a very interesting week with the big collapse in the U.S. markets. Breaking down here, we're looking at the FANGs index. This is the technology leaders. You can see we've broken down below the middle standard deviation channel, down near this lower standard deviation channel. This puts us back into 2019 and 18 highs. You can see back over here, all the way back down here. This has historically been pretty strong support down in this blue and green lower area over here. So I'm kind of looking at this as a bit of a washout low. I'll be honest with you, I think traders panicked last week. I think there's a very strong potential that we're going to see some sort of a rebound recovery here off of this. And I think everybody just pretty much panicked. We are in short-term bearish trending, no doubt about it. All of the major indexes are moving lower. And that means that we are in short-term trending. But long-term, you'll see with my rotational modeling system, everything is still quite bullish. And there's a very good chance that we are going to see some sort of an extended move here. And I'm going to show you some things here in a bit that are going to be quite interesting. So let's go over the basic chart. So obviously downward trending in the FANGs. I'm looking for support possibly in this area. Now obviously it could break lower. We could see an extended downtrend depending on what the Fed does. But right now at the end of the week, I'm thinking this could very well be a deep washout kind of a move, given what's going on with the Fed, given what's going on with China, and something similar to this. You can see here with the COVID collapse and the sell-off that we had at the end of 2018 when the Fed raised rates. You can see we had a bit of a roll down lower for about 3 or 4 months. This has been a little over 3 or 4 months. This is more like 8 or 9 months. But this is getting right down into these support channels in this blue channel down here. And I think we're going to find some support here, hopefully, if my analysis is correct. Okay, so now we will come this way to the U.S. stock market index. U.S. stock market index, you can see here, still well above the 2019 highs, 2020 highs, roughly, or before COVID. You can see we've had this pullback. We've got new fresh lows over here, which is very, very interesting, but they're dancing around these previous lows back over here near the beginning of 2021. This is going to be a very interesting week as things play out. The selling pressure because of inflation and because of earnings for Q1 came in and really shocked everyone. But this could very well be a washout type of a low. U.S. economy is still fairly strong. U.S. dollar is still strong. The dynamics of the U.S. dollar with foreign investors pushing money into the U.S. markets is still quite strong. It wouldn't surprise me to see a move down below this level, this blue line here, washing out and rotating back up to try to find some support. And I believe that's kind of happened in the Nasdaq here recently. We've gotten below the 13,050 level, which is a support level. And I believe the reaction last week was really a sign of support. So again, we shall see how this plays out. Obviously, if it breaks down, my rotational modeling systems will turn bearish. The very clear triggers. Right now, very, very early into this setup. So we're short-term bearish, long-term bullish, and I'm giving you my read that I think we could be looking for some support if these levels actually hold up. Next chart is the Smart Cash Index. This is the global index. And this is one of the reasons why I think support is starting to form is this double bottom. This double bottom right here in the Smart Cash Index between last week and the week before, and I'll show you also on the Volatility Index, aligns back here with the 2018 lows. So understand that globally, and this includes the SPY here, has already come down. It's come down to the 2018 lows. It's come down to the middle 2019 lows. It's right at the early COVID collapse, which is actually back over here, but it's right at this exhaustion phase before we found some support. And that's why I think we might be looking at some support over the next couple weeks. I really believe that the markets may be at a washout period, call it a capitulation trend, where this could be a washout bottom, setting up for a new potential move to the upside if the markets find some support and people realize that the new normal is not going to be the reflation type of trade activity that we saw over the past 14, 15, 20 months. So now let's move on to the metals index. Okay, metals. Everybody, a lot of people have been asking questions about metals. Metals have been holding up extremely well with the US dollar moving higher. Back in this time frame, we saw this change of trend. Remember, December 2019, right here, was the end of the appreciation cycle. This began a new global depreciation cycle, which is going to lead to some price revaluation, which we've already started to see. I believe the markets may extend a bit higher, and I'll explain that to you here in a bit, but I believe that fear factor globally is pushing gold and silver higher. Now, we've seen this pullback. I drew this line because of this high here and these previous support levels back over here. We're at kind of a washout period here with gold. Gold may rally fairly strongly over the next 4 or 5 weeks, possibly up above 2,000. And this is because I believe we've seen this kind of fear, this capitulation. Remember back here, this is fear. Fear taking over market trends, people realizing that technology is going to produce lower numbers and that the U.S. stock market's going to produce some lower numbers. But lower numbers, again, remember, if a company makes $2 billion during a massive recovery phase and now all of a sudden makes 1.79 billion, yes, it's a lower number, but in essence, they're still making money. They're still making good money, and our perspective has to change. So they're not making maybe 15% return on investment a year. Maybe they're only making 12.5% return on investment a year. The numbers seem like a big drop because 2.5% from 15% is going to end up being something along the lines of a 12 or 15% drop in revenues. But in reality, they're still making solid revenues. So now we'll come back over here to the metals index. I think metals are going to try to bottom over here. My number in gold is the 1885 to 1887 level, and in silver, the reality is really more along the lines of like the 2350 level, 2370 level is looking fairly solid for silver. So we're going to see how that plays out. I could be wrong, but I think this is really kind of an exhaustion move in the market. The Valuations Index, this is one of the reasons why I believe we're getting very close to a bottom. Now, the Valuations Index has already moved down below the 2016 peak levels and below the 2019 levels here, mid-2019. We're down into levels that we haven't seen with regards to valuations in well over, if you ignore this 2019 rally, and go all the way back here, 2017, 18, 19, in this early phase, we're now getting back into some pretty solid levels. We could see this move quite a bit lower. So understand this 74.94 level could come back down into the 55, 60 level, and that would put us right down here in the middle range. But these are pretty solid, normal economic levels. So here's pre-COVID, here's COVID, this big spike in COVID, which was the Fed reacting to COVID and decreasing interest rates. We had this inflation trade afterwards. We had a deflation in the market after mid-2020. Things started to actually deflate as we didn't know what was happening. The speculation globally in the stock market had already started to take an effect. We'd still well above positive numbers. Remember, this number is double at 150 here, 200, 250, 300, 400 way up here. This is a big shock to the market, and this created a huge speculative wave, a huge price inflation wave. This was moderate deflation in valuation and price. We still stayed well above these normal levels. Remember, normal levels over here, even normal high price levels, have been in the 74, 75 range. Normal ranges down here are 45 and 50. Let me rephrase that, 50, 55. So at this point, getting back down into normal ranges is not unexpected. This was a huge influx of capital, huge global central bank intervention, zero interest rates, huge speculative phase. Moving back down into normal levels over here is what I expect the markets to do. In fact, to be honest with you, I kind of expect them to move down into these lower levels and then try to struggle back off of these lower levels for a while, kind of like we saw back here, 2018-19. So we'll see what happens with the Fed and with the markets, but this is all normal. The markets are moving back into normal ranges after this big blip, which was COVID and unexpected stimulus with regards to the election and the Fed and everything else. So as we move forward, we go to the commodity to gold index, which measures how commodity prices are reacting to the price of gold. Gold is holding up very well. This is actually a complex index. And you can see again, look at where we're at. We're down to 2.2 on the index. We're down near these historical low levels. So you can see here, 2016, we got above it. This was, again, a rally phase in commodities, moderately strong rally phase. 2017, we rallied up. 18, we came back down into these low levels, found a bottom. Rallied back up, down into end of 2018, found a bottom. Rallied back up in 2019, kept retesting these lows. COVID came down and established a very deep low, way down into the 0.7 level. Now we've come back up with this expansive phase through speculation and engagement. Traders came out of the woodworks, got into the market. Everybody with a dollar at home started to get into the market thinking they're going to make money. Now we've seen this massive deflation phase. And remember, look at where this peaked. This peaked up here in early, I would say, May 2021. And look back here. We come back to the valuations phase. And look at over here. This is where this bottom down here in May 2021. We come back over here and look over here. Over here in February, March, April, May, June, this is the peak of the global market index, 2021. So understand that there's a lot of alignment that says that in February, March, April, May, in this area, right in here, markets shifted dramatically. The U.S. markets were laggers in how they shifted, but what we're seeing here is this massive peak in early 2021. So this is really February. Massive peak over here in the commodity gold index. This is when lumber shot way up. And now we're seeing everything move back down into normal ranges. My expectations are we're going to go end up somewhere down in the 1.1, 1.2 range, maybe a little lower, seeing that commodities are going to move down into a very normal range, possibly down into this area here, and try to rebound back up. But hopefully you can see from these charts that everything is starting to move back into this lower quadrant. It could stay in this lower quadrant or this lower range for many weeks and many months. So indicating that we could see a kind of a stagnation in the markets for many weeks, many months going forward. But understand that this is really a bottoming phase setting up. So, and then this is the Volatility Index, one of my favorite little indicators that I created. It's a custom index, helps us measure buying and selling. We've got it expanded out to 2015 and 16 all the way through now. I will tell you that the 6.6 level is considered fairly bearish, but I will tell you that we have seen continued upward trending from these levels in the past. So here, 2016, 2017, 18, end of 2018, bottom down here around 4, set up a nice early warning bottom back here around 6, same thing back here around 6. COVID blew through it, went way down here to roughly 1.7, 1.8, and we've seen this real strong rally phase back out of the market. So now, if we've moved it back into normal phases here, and we really start to look across these lows around 650, you can see we've got a series of lows here, series of consolidation, more lows here, more lows here, more lows here, that eventually we get back into this range back over here where we start to see some real support. That's why I'm starting to think that we could be near some capitulation phase. Markets could come down, maybe get a little bit of a wick down into this area with some early selling next week, and then maybe try to form a base here. Kind of like we did back over here, kind of like we did back over here, and back over here. This is moderate selling, 15, 18% downward in the market, finds a base down around 6. In this case, it got a little lower, but found a base, then rallied for another 9 months. This was the end of 2018, bottomed on Christmas Day, rallied all the way through 2019. This was early COVID, came back down, hit a deep, deep low, rallied back up above 6, which is a good indication that we're starting an upward trend, and then continued to just rally. As you're well aware, this was a huge move, almost 100% move in the Nasdaq. So now we're back down here near 6. We've hit some lows down here below 6. Could we be near a capitulation bottom? I'm thinking that it's very likely that we are. Given what's going on in the markets, I'm thinking that we're near a bottoming phase in the markets. I believe that's it. Yep, okay. So now we come back over to my indexes. This is for May 1st. Watching the markets break down last week seemed like a capitulation move in price. This happens when price overextends in one direction, providing a potential washout in price. My longer term models are still bullish, and I suggest we wait out this trend. All of the U.S. major indexes have moved to short-term bearish. The next few weeks could be critical. We're already well prepared for this, so understand that the short-term system has moved over here to bearish. Stocks, we're still holding a very small percentage, which is really a long-term position. We're 65% cash, 25% metals, waiting for that big breakout move, and 10% into bonds. Longer term, the alternate allocation level is 85% cash, 10% stocks, and 5% bonds. We're really just waiting out this pullback to be able to jump back in when the market's set up. Oops, wrong direction. And then here's our trending system. So the YM is bearish short-term, bullish long-term. ES is bearish short-term, bullish long-term. The Nasdaq is bearish short-term, bullish long-term. Industrial is bearish short-term, bullish long-term. Transportation is bearish short-term, bullish long-term. SPY is bearish short-term, bullish long-term. Gold is bullish, both short and long-term. Silver is bearish short-term, bullish long-term. I really think this is going to change the bullish here fairly quickly. And oil is still bullish. We'll take a look at the charts right now. So we're going to start off with the S&P. This is the E-mini S&P futures contract. These are the lines I drew last week with the excess phase peaking pattern. We've come right back down to these lows. You can see it's still bullish here. Weekly, bearish, daily. That's what this new pink trigger line is. The bearish trigger tells us that we've moved back into a downward trend on a short-term basis. You can see we were in a downward trend or a bearish trend back over here that ended fairly quickly. Really, we rely on this. So what we rely upon to make decisions is this. This tells us that we need to be cautious and have pulled capital away from any risk in the market, which we've already done. Nasdaq is bullish long-term, bearish short-term, big solid selling last week, gone into extended selling here. These yellow triggers and this blue trigger here warn a potential bottoming, meaning an exhaustion in downward trending. You can see the line I've drawn again here. We're very close to support levels. We, obviously a big breakdown to the downside could send everything on the long-term model into bearish. But long and short of it, ladies and gentlemen, we are still green. We still have green triggers. We're still bullish. We're near this support. If we see some sort of a recovery here, we could see it do something like this and try to move higher. So this is, if a breakdown were to happen, this is what it may look like. And if we see a recovery here, this is what it may look like. Let's go to the industrial. Industrial average broke out of its channel again, very close to these support levels again. Everything is setting up just like this. And it's very funny how after this extensive rally, we've seen the markets pull back. Look here, the Dow Jones Industrial Average has pulled back 10%. The Nasdaq, which has pulled back more, has pulled back from these highs 22%, let's call it. So understand that we've seen a pretty big pullback. The Nasdaq's officially in bearish territory. The S&P might be as well. Let's take a look. $14, 15%. Let's call it 14% right there. So I wouldn't call this bearish territory yet. The Nasdaq is 20-some percent downside, 22% downside move is considered a bearish trend. But my rotational modeling system is smarter than that and has not labeled this a bearish trend yet. It will if it continues to break downward, and we'll get a very clear trigger. But understand, on the industrial average and the Nasdaq and the S&P, the long-term system is still bullish. And this support level right over here, call it, this is the Dow Jones, 32,930, is going to become a fairly critical support level. Okay, so it is bearish in the short term, bullish in the long term, which is why we're still holding out hope that there may be some sort of a capitulation bottom right here. Transportation Index, a measure of how the economy is expecting to move in the future. Now, this is normally 4 to 6 months out into the future. So picture this as being July, August, September right now. So right now, we've seen this peak in the Transportation Index. We've seen it roll sideways. We're still bullish long term, bearish short term. We could see it move a bit lower, but this is our support level. This is where we want to try to see the Transportation Index hold up above these levels. Now, a move to normalize the Transportation Index could see it move back down here to 12,000, which would be a drop in what the economy is expecting, but it would still be considered historically high compared to where we're at. That would be the 2019 highs back here before COVID. So understand that we could get a bit of a downside move if the economy contracts a bit. The stocks could still move lower, but we could still see a very strong upward movement here. And I'm going to show you this here in a minute. So the SPY, the actual Standard & Poor's Spider ETF, is pinkish color, but still bullish, and on weekly, and daily is bearish. So all of them are bearish short-term, bullish weekly, which means that we have a fairly strong opportunity for some support to really hold on a capitulation low. Now understand that we've seen these kind of pullback lows quite a bit. So we've got kind of a low level here. We've got a pullback low level here. Rallies up. We got a pullback low level here. Rallies up. And a pullback here. Rallied up. We could be looking at this as some sort of a pullback and a rally phase here if we start to see some real positive change. And what would be positive change? Let's talk about that. GDP went negative primarily because of exports and imports is what the news is telling me. My look on it is consumers are pulling away from certain expenditures with high gas, high food, and high everything else prices. I think these price levels need to continue to come downward. I would expect to see crude oil, which you'll take a look here, move considerably lower. You can see we're still bullish here on the day weekly and bullish here on the weekly, although we're now in pink trending here. We're in a bit of a flag formation setting up here. Kind of maybe tough for some of you who don't know what a flag is to see, but if I were to draw a line across here and then a line across here, that's a flag formation. And what we're looking at here is we get to the peak, we come back down, we go 1, 2, 3, 4. We're getting near an apex here. And I believe oil has already peaked. Consumer demand is shifting. China demand is shifting. Global demand is shifting. I believe oil is going to break to the downside, possibly back down into the $76, $77 range. Everyone says, a lot of people say that it's impossible for it to do it. It is not impossible for oil to go back to $70 or $80 a barrel, given the fact that China has shut down and that the rest of the world is dealing with high-priced gas after this expansive move up, which really took place, if you look here, this took place back in February of last year, started seeing this big rally, and that was well before the China lockdown, well before the war in Ukraine, Everything is unwinding right now, and I believe we're going to unwind, come back down to find some normalized price levels, and I think the $75 to $80 level, if you can see back here, provides a very solid range. So let me draw a range around this potential area that I'm drawing, and oops. So really, ladies and gentlemen, this is the range, if I can get it to move up just a little bit, that I expect oil to get into. I expect it to fall down into this little range and to stall in this range before trying to make another move. It's a deflationary move. We've had the speculative bubble. We've had the bump. You kind of like, the way I explain it to everyone, it's like tossing a big rock into a pond. The big wave goes out first. Here's our big wave. And then we get a couple of little waves, and then eventually it starts going back down to normal levels. The pond does. It just dissipates. And that's kind of what I think we're happening right now. Okay, so let's take a look at what I wanted to show you here with regards to these longer term cycles. And what we're going to do here is we're going to look at the NQ, come back over here, and try to drag this a little bit. And what I wanted to point out, ladies and gentlemen, is this. We may be looking at something that most people are failing to consider right now, is that since 2008, we've had extended quantitative easing with the global central banks and primarily the U.S. Fed. Then we ran into a little bit of a period. Now understand, there's QE1 and then QE2 and then QE3. And then we went up into a period where there was moderate tightening right here before an election. And then we went into extended bond buying and QE4 that lasted perpetually. And then we went into moderate tightening here with the Fed raising rates to 2.5%, which caused this big dip in the market. This was actually a bearish trend on this weekly chart. Then we ended up into 0 or 1% interest here. The party continued rolling. This was 2019, all the way up to COVID, which was a very deep rotation in the market again. And this was when the Fed went to 0 and extended QE, let's call it QE infinitum, took off. And this is where we're at here. This was the major speculative phase. So if we look at this from an Elliott wave count, which tends to count in 5 wave cycles. So basically, if we look at it, well, I'll do it this way. You go A, B, C, D, and then E. Now, E typically is as long as C, if not longer. So this last wave could be much bigger than the C wave. And typically A is the shortest wave of the primary wave. So this is an upward Elliott wave count, counting 1, 2, 3, 4, 5, or A, B, C, D, E. So now, if we look at the move from 2008 or 9, the bottom, up to this move here in 2015, call this A. This was a very moderate move. Now understand that this was plus 314%, but now understand here, we get the price distance and get the price distance here. What's important to understand is that this was a 3,583 point move. This was a 12,835 point move. Let me get the calculator real quick. So we will do 12,835 divided by 3,583. That is a 3.526% extension. So in essence, this move is 350%, roughly 352.6% of this move. Oddly enough, that is a Fibonacci number. Oddly enough, if there was to be some sort of a E move, which remember, my drawing here suggests that from here, if we were to see this move here equal this move here, we would have to see a move of at least let's call it 13,000 points. 13,000 points in the Nasdaq would put us up into, let's go down a little bit, let's call it here. So we would be looking at somewhere around 26,700, call it 26,200 to 26,700 in the Nasdaq if we were to see an equal length move here. If it were to be more than this, which remember, wave E potentially is always equal to, or should be at least equal to this. It can be shorter. So it can be, say, half of this move, or just do something like that. This is an exception to the rule. Generally, it is the same length as this move here, and that would put us up into this 26,000 range for the Nasdaq. So understand, I've drawn this into a number of different charts here, and I want you to be aware that if my capitulation theory with regards to these markets, so take a look here at the ES, if my theory with regards to capitulation comes true, we take a look here, 2008, come back down here, so I got some lines over there at the end. So we come from the lows of 2008, get my mouse to cooperate, to the highs here, and then come back down to these lows as wave B, looks like right about there. And then wave C, we skip this. So we call this basically A, B, C, D, E. And let me draw that for you so you can see what this wave really is a completed 5 wave. Right here. So look here. Whoops. So from this low point, I'm going to try to draw what actually took place and what I'm seeing here. We have an A move to here, a B move to here, a C move to here. This is right prior to COVID. A D move to here, which again, deeper. Now you're going to scream at me and go, well, this is deeper. Yep. Okay, I get that. Let me explain this. And then an E move up to here. Okay, so if we count this as 5 waves, you're going to go, well, this doesn't make any sense, because understand, Fibonacci theory teaches us, or Elliott wave theory, that the pullbacks, these levels, cannot be below this previous level. So how did this get below this? Oh, that's pretty simple, ladies and gentlemen. This is an A, B, C wave up, a correction wave down, which would be a B wave, and then a C wave up. So in essence, this becomes wave 1. This becomes wave 1. This becomes wave 2. And this becomes wave 3. So when you think about it, now let me remove all of these drawing tools, and I will try to do this again so we can see the move. From this low up to here is a wave 1, wave 2, and wave 3, all the way up to the highs. So now let's take a look at the pricing. Show the pricing factor, and show the pricing factor on this one. So this is 15,850. This is 25,5075. Get our calculator back. Clear it. 2550.75 divide by 1585. That is a 1.609. That is almost a perfect 1.618 expansion, Fibonacci expansion of this initial range. So this range here was measured as, let's call it A. This was a correction. Let's just, for the heck of it, see what this is. So turn on the price factor. So we have 1137. So we will take 1585 point, divide by 1137.5, roughly 0.39. Okay, that is almost perfectly a 382, or in this case it would be the opposite, a 618 retracement. How can I prove that to you? I can come in here to Fibonacci ranges, and I can go ahead and draw from the bottom up to this top, come across over here, and I can point out the fact that, this pullback represents roughly a 60%, a little over 68% pullback down to these lows. And this was a very deep COVID low. So understand that we are having near perfect Fibonacci alignment here. We are in alignment with this trending challenge, and this would essentially tell us that this move here, this next move down here, which could still move lower, don't get me wrong, could come back down into these levels or deeper. But if this is capitulation low, and we see some sort of support taking place, let's say somewhere over in this area, then, ladies and gentlemen, we could be looking at least this type of a move higher, which would be a 1-to-1 ratio higher, and that would put this ES up at 64, almost 6,500. So we are looking at potentially a wave 5 expansion out of this that could be a blow your socks off rally. We're at 4127 right now on the S&P, and we're talking about the potential of being somewhere up around 6,600 or higher if this happens. Now, it could be smaller. It could be a 0.5%, putting us up at 5,400. Could be a 618, putting us up at around 5,800. But even this, a wave 5 expansion from this level could be an explosive, a very explosive move to the upside. And this is what I'm going to warn you right now. We need to be very, very cautious about how we approach this. We're protected in our trade because we have our, wrong direction. We have our cash in reserves. Very small amount in stocks and protected by metals. Metals will, and I'll show you metals real quick. Here's gold on a weekly basis. And you can see that we have just flipped into the bullish trending here for gold. This is bullish trending. We're going up. We've ended this massive phase. And what I'm going to show you here, if I scroll all the way back and get rid of some of these lines. Oh, there's a bunch more. Let me get rid of all of these lines. What we're looking at here, ladies and gentlemen, from this end of the phase peak here, we've had a cycle of about 9.5 years. So it really ended back here in about 2010 or 11, and it carried all the way out to 2019 December here. This was I can make these thicker. Oh, that's the horizontal line. Okay, I don't need the horizontal line. What I want for all, make them thicker. So this was the end of the appreciation phase. This was the end of the last depreciation phase before this. So what we have here, ladies and gentlemen, is this was the blow-off peak that occurred after the last depreciation phase. This is the new depreciation phase. So now understand, if we take a look back over here, what gold has done, this was the previous depreciation phase. From 2000 roughly in 10, we've got to go all the way back over here to 2000. So roughly from here to here. This was a 9.5-year cycle. And I want you to see what gold has done during that depreciation phase. It rallied up. If I move this line from the low to where we ended, 340%. So now we come back over here from where this depreciation phase or this appreciation phase ended. If we were to try to take a look at the 340% rally from near this level, which would be right up here, a 340% move would put gold, and I'll have to shrink this way down, even further. Bear with me while I try to get the numbers. Wow, even further. Okay, well, let's shrink it down even further. 340, wow, even further. Didn't expect to have to do this. Okay, there's our 340%. Try to get it close. There we go. So it would put it at 68.48. So understand, that's what happened during the last major appreciation or depreciation phase with gold. Depreciation phases can be extremely powerful. They can go on for typically this will last until right here, 2027, 2028. In fact, November, it says 13th, 2028. So this rally phase could be extremely explosive for gold. And if gold could rally from this point 340% and then blow off another roughly 100% higher, because remember, that was a move from 1,000 to 2,000. This could move from here to here and then double very quickly from 7 to 14,000. Now, just for fun, let's take a look at silver. Take a look at the same thing. Let's remove the lines. Let's draw our cycle trends. So from roughly 2,000 here to 2010, roughly here. It's too long. 2009, right there. So I got to move the start. Should be right here. And what I'm doing is, this is roughly a 9.5-year cycle. I'm trying to get it aligned properly because it ends at the end of 2019. So right about there. Okay, so now let's come in here, make this thicker so everyone can see it. And let's take a look here. Silver rallied from roughly $4.87 up to approximately $18, $19 a share or an ounce during the end of the last depreciation phase. Then it rallied from $19 an ounce up to $50 an ounce. So that's a 150% rally in the blow-off phase. Now, if we were to see the same move here, and this was I got to take a look here, 280% move, am I correct? 283% move. So from where silver is right now, I'm going to squeeze it all the way down, make sure I have enough room. From where silver is right now, around 23.70, so there's 24, 283 would put it up around $91 an ounce. And then remember, from here, which was the end of this point, during the blow-off phase, silver could rally another 150% from here. That would put it up in the $220 to $240 an ounce range. And that's all going to likely happen over the next 5 to 6 years in the metals market. Okay? It's a very, very explosive move to the upside. And I'm going to explain to you how this is likely going to continue to work in our favor going forward. If in reality you had the opportunity to buy gold and silver right now at 22, 24, 23 silver, or even $1,800, $1,900 gold, the next 5 to 7 years, you could be looking at literally 4, 5, 600% return on your money throughout this incredible rally phase. Now, this is assuming that it follows this cycle and does something similar. It may not. It may get up into this 80, 100, whatever level and not continue to move higher. But I truly believe that this is what's likely to happen. We're in the very early stages of a depreciation cycle, and it's just a matter of time, in my opinion. Okay, so I've given you a lot to think about. Number one, we come back over here to our charts. Well, let's just go back to our trade tank charts. Remember, this is the Dow Jones Industrial. Everybody kind of watches this. The Nasdaq is under some pressure right now. The Dow Jones, the S&P are all holding up fairly well. Short term, it's moved into bearish trending, but we're watching these support levels. The Nasdaq has broken lower. You'll see it here on this chart. Actually, let me kind of crunch this up. You can see here this move last week. This is a weekly chart, still bullish, still green, long term. We've gotten below this support level, this historic support level, which is important because the Nasdaq could come back down and try to retest these levels down into the, well, let me draw across here. Could try to retest this level or potentially down into this level. And that would represent a fairly deep pullback for the Nasdaq. So understand, it's not too far away from where we're at, but it would freak out a lot of people. But ultimately, ladies and gentlemen, back over here, when you take a look at these charts and you take a look at this longer term trend, let me spread this back out. And what we're really looking at here is a very strong potential for a wave 5 pullback leading to or a wave 4 pullback leading to an expansive wave 5 to the upside. And what would that look like? It's fairly simple in my opinion. So we've navigated quite a bit of headache. We have a fairly strong U.S. economy. We have consumer engagement. What would likely happen is we'd be looking at credit debt issues across the globe, not in the U.S., but still could affect the U.S., fall apart over the next 4 to 7 years. That would mean China, Asia, Europe. Imagine war in Europe. Imagine potential issues in China, Asia that don't go away. And imagine the U.S. economy stays relatively immune from some of these problems. That would lead the world to continue to pile money into the U.S. markets, leading the U.S. markets higher, creating a dynamic that we haven't seen probably since about 15 years after World War II. That would be in the 40s and the 50s and the 60s, where we have this huge dynamic where the U.S. economy is the strongest economy on the planet, and we're seeing massive, massive growth and price appreciation, particularly in stocks. Now, what it means for housing prices, different story. Massive U.S. economic growth, if we were to have something like that, would likely lead the Fed to move interest rates up above 4 or 5%, and that would put a kibosh on rising home prices. So we'll see how that plays out over the next couple of years, and we need to kind of watch how this plays out long term. But I'm very, very hopeful right now that my analysis is providing some insight. Stay safe. We've been in cash for at least 6 weeks now, I believe, waiting for this trend to die out. We did this as a move to protect that capital. That's what I help you do, protect and grow your capital, and using my cycle systems to try to predict what's actually happening. I'm looking, 10, 15, 20 years into the future, and I think the biggest opportunities of your lifetime are setting up. And I mean the biggest, because once we get up here, if we get up here, this completes a massive wave 5 growth, and then we have a contractionary phase that could be just as powerful and potentially come back down to levels like this, which, remember, this would be essentially a 70, call it 65 to 70% downside move. And that is where we're going to be able to make a tremendous amount of money being able to ride these and be ahead of this. So be aware that this is what's happening. I'm teaching you. I'm helping you. Follow me on YouTube. Follow me on Twitter. Help me get my likes and followers up. I'm going to keep guiding you through these markets for as long as I live, and I will continue to provide the best research that I can. Thank you again. Talk to you soon.